Hi, everybody. This is Seth Martin, and welcome to this week's Middle Class Investor. It is Sunday, about 1 o'clock, and we had a pretty good down week last week in the market. The market for a while now has been kind of looking tired right through this area right here. And, we've been talking about how narrow it is, meaning, when the market gets narrow, that means fewer and fewer stocks are actually contributing to the rise of the indexes. And that's what I mean by narrow market. And, it's kind of, it makes sense, logically, that if there are fewer stocks in uptrends, then it's harder for the index to continue to make an uptrend. So that's kind of the backdrop under this. And we do have, these are the old highs back here in May. And then this is the August 24th low. And then I forgot what this week is here or this day, but there was a lower high here. And so in order to, have a downtrend, we've got to at least make a new low, a low below the August 24th low. So technically we don't have a downtrend yet, but we have been talking about the reward to risk. Somewhere in here, I think I started talking about, taking money off the table or just looking at the market in terms of the economic data and just how bullish everybody was right in here. Usually when everybody's on one side of the boat, the boat tends to flip over. And of course, that's what you had here. The boat flipped over, market went lower. Now we've had a really strong recovery here, and remains to be seen whether or not the market will, continue this trend upward into this resistance area, or if it will continue the rollover to the downside. And there's no way to know that, but again, you look for clues in the market. And one of the things that we can look at is we can look at these the oscillators. Now this is on a weekly chart, and you can see that the MACD here is rolling over, or is trying to roll over. Now I've seen this happen many times too, where it kind of comes down and just kisses that and goes right back up. But it does appear that you can kind of see that did that here. It kind of came down and then turned back up. But it does appear that this wants to kind of roll over and go lower. So, we'll continue to watch that. I've also been noting as the market continues to make higher highs, these peaks in the MACD, they tend to be lower and lower, and that usually gives us some internal, that's usually a sign of some internal weakness in the market. And you can look at almost any oscillator and it looks like this. Let me make it bigger so it's more distinct, but you can see how this high is higher than this high, which is then higher than this high. And that's just indicative of a market that has some weakness internally. And we've mentioned that many times now with the narrowness of the market. So let me turn that study back off so we can kind of get the price action to show a little better here. If we look at the VIX, the VIX just has a tendency, it can't stay down forever, so I could never remember what the written part is for the VIX in my watch list, so it's easier for me to just type it in. But you can see here the VIX kind of shot back up. We'd put this circle here because this is kind of a bottoming. You can kind of see the rounded little smiley face there. Kind of was trying to bottom out, ran up, pulled back, and then broke out again. So this just helps us confirm, the direction of the market. The market was clearly down. There was clearly some fear in the market, and here we are, back at 24, which is, it's getting up there. Given that I was really surprised we went back down into this area, given how narrow the market is. It just seemed like there was going to have to be a sell-off, but the market, there's a saying, the market can remain irrational much longer than you can remain solvent. So, and really the meaning of that statement is, you kind of want the market to show you the direction before you kind of get on board in the direction. So, if you say to yourself, I think the market's going to go lower, and you take a position, you position yourself for a lower market, and the market continues to go higher, well, that's the meaning of that statement. Even though it appears to be irrational, the saying goes, the market can remain irrational much longer than you can remain solvent. So typically what you want to do is you just want to wait for the market to stop going up or stop going down, depending on where you are in the cycle, and then take a position after the market shows you its hand a little bit. That's that's a tricky thing, because let's go back to here, for example, and let's say the market kind of rallies and then it pulls back and it rallies. The more confirmation you need for this, pretend like you don't know all this back here. Let's just assume we're looking at this and the market's been doing this, and we're saying, I don't know if it's bullish yet. The more evidence you need, for bullishness in this case, the more risk you take, because technically if I got in here, well then I'm really not wrong until it breaks this low back here. So that necessarily means that I have to take more risk. This risk right here, from here to here, is my risk. I don't know, can everybody see that? If my previous low that was an important low is back here, then my risk is from wherever my entry is, let's say right here, to here. That's the risk that I'm taking. And the reason that's the risk is because if the market pulled all the way back to, say, right here, and then turned around and ran up, that would still be in an uptrend. Obviously, this depends on how you define the. Maybe you stop out right here, just because if the market pulls back to here, then potentially you got a new trend change. But my point is, whenever you decide to take a position in the market, your risk is basically the place at where you decide to be. You say to yourself, I'm wrong, and I'm going to sell that position. And so, and the answer to where you do that is just wherever it's logical. So in this case, if I were to enter somewhere around here, it would be logical to exit right here if the market pulled back past that, or maybe exit below this trend line, although we wouldn't really have a trend line at this point yet. So you just have to, the same thing can be said here. I mean, you could say, oh, the market's topped. Well, technically, you never really know if it's topped. Now, it is true that this is a topping pattern, this whole big, year and a half long arc across the top of this chart. But you can't really say the market's topped until the trend changes and it starts making lower highs and lower lows. That's how you know it's topped, technically. But the longer you wait for that evidence, the more risk you're taking, because the market could turn back around and go the other way, and technically it could go all the way, like say right up here to 21.25 or 21.34, whatever that is, and then roll over and still go down, and now be in a downtrend. So you have to think. This is kind of a hard concept to understand, because we don't really, as human beings, we don't really think in terms of probability. But you really have to learn how to think in terms of probability. You have to think to yourself, okay, because the market Sometimes it goes sideways. It sometimes goes up. It sometimes goes down. It's really there. It goes through cycles, and really all you can do is enter at a place where the risk is relatively low and the reward is relatively high compared to one another. So, but it's not an easy thing to think about because we kind of either want to be right or most human beings want to be right. So we want to say, well, the market is going down, and so we want to position ourselves accordingly. Or we want to say the market's going up and we want to position ourselves accordingly. But really, from a probabilistic standpoint, you need to try to avoid doing that. You need to look at where the market is relative to previous highs and lows and important swings, and then ask yourself, okay, the probability is, if I'm in an uptrend, the probability is that I'm going to go to this area. But there's a lot of stocks, for example, that are in downtrends, and so there's a lot of potential risk in the market. So maybe I just forego this potential reward here and just step to the sidelines and say there's just too much risk. That's a perfectly legitimate way to approach the market, and that's a probabilistic way of approaching it. Okay, having said that, let's check some of these other markets that we look at from time to time. Let's look at the 10-year Treasury, and I'm going to show you a short-term Treasury chart as well. And we're going to talk about the Fed because the Fed has a big announcement on Wednesday about what they're going to do in the market. And of course, nobody knows, right? I mean, somebody knows, but they don't release that information to the public. They announce it where everybody hears the same information at the same time, and that way, that's the fair way to disseminate information to the market. But you can see here, yields were down last week again. They were up the previous week, but we had 3 weeks in a row where they were down. And here we are back to slightly lower yields. So we're still above 2% on the 10-year, but just barely so. I want to show you a short-term interest rate chart. It's called the IRX. And these are short-term Treasury yields. And I just want you to notice that since 2010, way back here, we've now broken out of this range here. Let's put it right there. So you can see short-term yields have broken out of this range that goes all the way back to 2010. Now, what does that mean? Well, it might not mean anything yet, but it could mean that, as long as we were in this chop zone here, the Fed was just going to hold rates at zero. You've heard me, or maybe some of you have heard me talk about how the Fed actually follows rates. It doesn't really set rates. And this is one of the rates it follows. It follows the 3-month Treasury. And if you look at the 3-month Treasury, it's about 0.2%, 0.23%, something like that. So this is kind of similar to the 3-month Treasury. And you can see here that we broke out, and the yield here on this particular chart is 0.213. This tells me that the Fed will raise rates. Now, you can argue, well, golly, the economy still seems weak, blah, blah, blah. Why would the Fed raise rates? It doesn't really matter. The Fed follows rates. They don't, this is one of the things that's so hard for people to understand, mainly because they want to keep up the appearance that they raise rate, that they control rates, they control the economy. They're, the wizard behind the curtain, and so on and so forth. But none of that's true. They follow rates. You can, if you study this carefully, you can easily see it in Fed meetings. If you chart it against like a 3-month Treasury. So I welcome you to go do that if you like, to prove it to yourself. But I'm going to go out on a limb here, and I'm going to say that the Fed is probably going to raise rates on Wednesday, only because I see that yields have broken out on the very short term, and this is what they look at to set rates. So I'm going I'm going to make a wager that the Fed will raise rates on Wednesday. So now that we're on the record saying that, we'll wait until next week to see how that turns out. I might have to eat some crow. I certainly wouldn't invest or trade based on that information or what you think the Fed may or may not do, because it can be significantly volatile during that half hour or so where the Fed's talking and they release their policy statement. We're still looking at Germany and the UK. I mean, everything looks weak right now. We had a really weak week. And obviously, if we break these previous lows, the selling is going to pick up on these indexes. So just be prepared for that. Same with the U.S. indexes too, because we haven't made a higher high, and it doesn't look like we're going to. If these continue to pull down and pull down past the August lows, you're going to see this selling pick up pretty rapidly, I think. The euro's still bouncing. We got a bounce last week. It followed through and continued that bounce this week. And I don't know, Draghi's trying really hard to weaken the euro, talking about printing money and having their own QE program and all that stuff. It just doesn't seem to be working. It seems like when he talks, it goes up, and when he doesn't say anything, it kind of goes down. Who knows? But the prevailing wisdom in the market is that somehow the U.S. is very, very strong, and it's a good economy, and Europe is weak, and so blah blah blah. That's how the trades are going to line up. We can look at the dollar real quick. Whoops, not too far. You can see the dollar trying to break out, and it's pulling back now. And this is one of those little turns on this MACD that'll probably turn out to be, instead of a rollover, instead of this rolling over and going lower, it's probably going to kind of flatten out and then go up like that. So the dollar is just consolidating here, but it looks like it wants to break out and go higher and make some higher highs, maybe up as high as that 105 area before we get a pullback. Let's see, we got gold. Gold has just been, destroyed recently. Gold and silver, but it is at an area that looks to be support. So there was a pattern that developed here that's kind of we've been talking about an ascending wedge for a long time that really never came to fruition. Well, this, if I were to draw some lines around this, you would see a descending wedge on a much smaller time scale, but descending wedge nevertheless, and usually when it breaks out above this line, that usually means good things for the market that's showing a wedge pattern. So just wanted to point that out. I don't know, the market, it's definitely in one of those phases where you kind of want to just sit back and see where it's going to take you, unless you're going to, sell some credit spreads or something like that in the options market. But if we go back to the Russell and the NASDAQ have been slightly weaker because they have more mid-cap type stocks in them, stocks that are just a bunch of small stocks that typically, when you have an up cycle, like a boom cycle, a lot of times those will take off first just because, they're smaller, and smaller company doesn't need as much revenue to go up pretty big. So usually shows up in a pretty big way in those issues. Let's look at NinjaTrader. There's not a lot that I want to show you this week. I mean, the market was clearly down. If you look at NinjaTrader, this is showing an ABC course. The problem with ABCs is you would enter trade here and you would have a stop set down here, because the reality is, again, you have to think in terms of probability. The probability is that this kind of bounces from here and starts to make higher highs and makes some target up here. But there's nothing saying that it couldn't kind of come up and then just totally sell off. And now this ABC, this C wave, now kind of becomes a third wave. And that's kind of the whole challenge with the Elliott wave process. I like it because it gives you kind of a big picture to be thinking about. For example, if you're looking at this and well, maybe this isn't even a good enough example. If you look at like let's look at oil. Oil's a good example. Let's take a look at oil. Here's oil, right? So oil's been selling off. Well, oil right now is at support. Okay. You can see the support area right there. Okay. So what happens when a market is at support? Well, it tends to kind of bottom and then go to resistance. Well, where's resistance going to be? Well, resistance is going to be right here. So the big picture is, the oil's been in a downtrend, but this downtrend is starting to lose steam. You start measuring some decision points off these previous swing lows, and then you can kind of generate yourself some targets to trade to. So from 40 to 55 is a good amount of movement in something like oil for you to make money in. So this is what I mean by big picture. You just, even if you're trading on, let's say we're going to go down to a 15-minute time frame. At this level, we shouldn't be too interested in trading oil short. Now, does that mean oil's not going to go lower? No, that's not what that means. It just means that the market is at very long-term support, and that the probability is the market will bounce and turn the other way when you go down to a smaller time frame. So that was a weekly chart I showed you. This is a 15-minute chart. So you can see this is kind of chopping around, and we might get a little bounce, a little pullback, and then a bigger bounce. That might be what you would see in this market. But the thing about Elliott wave is it does give you a little bit of insight into the larger picture, which I do like that. But trading using it is very, very difficult. I haven't found that it's all that useful unless you're trading in isolation. For example, this is an ABC. It's showing an ABC right now. So in the ES or the S&P 500, we probably should be looking for some bullish stocks next week. We could actually go into the market right away and find a couple of bullish stocks and trade up into this area, something like that. Maybe make $3, $4, $5 on a stock, from here to here. So the key thing to know is the market really tells you just about everything you need to know. You just need to look at different time frames. So if we're going to trade a daily, then we need to look at a weekly time frame. Whoops, I just clicked on daily. So what you would do is you would use the higher time frame to develop your support and your resistance area, and then use the 5 times lower time frame to kind of fine tune your entry. Which is kind of what we're doing here. So anyway, did I close my? No, there it is. That's really about it. I mean, I could show you some of those stocks, but I don't know. I just think, could just cause your eyes to glaze over, just looking at chart after chart after chart. But trust me when I tell you that there's only about 30 charts that are in bull markets, and the rest of them clearly look like bear markets. So I think there's plenty of room for caution here. I mean, we had a big down week last week. I mean, that doesn't just happen. If you look at this chart right here, so we had this kind of interim high, pulled down, pulled back, pulled down, pulled back, pulled down. This is a 5-wave move. So this is, if we go, let's go back over. Let's see, this is a weekly chart. So let's go back over to NinjaTrader and pull up. Let's pull up. Let's see what I want to pull up. Let me pull up just this S&P 500. Yeah, I got the wrong time frame. Well, let me skip that because that could take a while to load. I don't want to do that. That's really, I know it's kind of like we're stopping abruptly here, but there's really not much to say. We're right in between, and this typically happens when the Fed's about to speak. The market kind of stops right in the middle of an area where it literally could go either way. And the truth is, if the Fed raises rates, we're not entirely sure how the market's going to react to that. And if the Fed keeps rates the same, we're not entirely sure how the market's going to react to that. So you just kind of have to sit on the sidelines and wait till the information comes out and look at the way the market is trading, and then find a trade. So I'm just going to leave it at that. I don't think it's very useful to sit around and talk too much about what the Fed's going to do. I gave you the best evidence I know for predicting. If you're interested, around the water cooler, talking to people you work with, if you're interested in trying to predict that, this is the best evidence I know for trying to predict what the Fed's going to do. Is look at the a short-term Treasury yield and see where it is, see what the chart looks like. This is in my opinion, this is how they do it anyway. So that's really about it for the week, everybody. I think the next couple of weeks, right up to the first of next year, there's going to be a few more cards coming out of the deck. There's going to be a lot more insight as to how this market's going to behave. It might just kind of hang on for the end of the year and then come out selling, next year. Or, people are big on the seasonality and Santa Claus rally and all that stuff. The market might just disappoint, It might just decide, we need to sell this thing off, There were no good, the shopping results weren't that great, and, so everybody just thinks the market's going to sell off. So we'll just wait and see. It's always entertaining to wait and see. In the meantime, if you have a trade, look at where you think it's going to go to, and then look at your risk and just line your risk and reward up and take the trade. I mean, you gotta get in the game. It's kind of like the lottery. There's no way to win the lottery unless you buy a lottery ticket. So it's the same way with markets. You're going to have to learn how to take a trade, whatever that may be, from an individual stock to your 401k. It's just not just going to automatically happen. So that's it for this week, everybody. Thanks for coming in, and we'll see you next week. Hopefully there'll be a little bit more definitive kind of information regarding the market and its direction, and we'll just analyze it. Whatever comes out next week, we'll analyze it. We'll have a comment on it. We'll talk about probabilities and where's the probable direction, where's the probable target, things like that. All right. Thanks a lot, everybody. We'll see you next week. Take care. Bye-bye.